Hello, everybody, and welcome back. Today, we're going to be talking about the FDIC because if, like me, you were growing up and you saw those bank commercials and it said, remember FDIC at the end, and you were like, I don't know what that means. Well, today we're going to have it explained to you because I have someone who would really know the answer to that right here. Dad, why don't you introduce yourself?
Hi, my name is Dave Mangan. I'm Mike's dad. I worked for the FDIC for 37 years, retired 6 years ago. Still dabble a little bit in the financial area, but my career was with the FDIC.
Right. So my dad here he's put together a little presentation to kind of explain what the FDIC does and all of its kind of the basics of what they do. And he's going to tell us all about it. So I'm really excited. And Dad, if you want to go ahead and.
Sure. I've put together what I would call a very high level overview of the FDIC. There's obviously a lot more about the FDIC that's there. So as I go through this, Mike, if you have any questions, feel free to interrupt me. And if you have some more at the end, I'd be happy to try to answer them. But let me share my screen here, and I put together a little bit of a PowerPoint. You says you've disabled participant screen sharing. Can you?
Unacceptable. Hold on a second. I shouldn't have. There we go. Try now.
Okay.
Cool.
Okay, can you see my screen?
I got it.
Okay. So in this little presentation, I plan on telling you a little bit about the purpose of the FDIC. Then I'll talk a little bit about its structure. And then I'll spend most of my time on what does the FDIC do. And I've really highlighted 4 areas, which I think are the major areas. They're actually the ones, if you go onto the FDIC's website, that they highlight. And then I'll give you a couple of resources that you can go to if you have further questions. So the FDIC was really established to maintain stability and public confidence in the nation's financial system. So what does that really mean, maintain stability and public confidence? Well, it all comes from what was happening before the FDIC was established. Mm-hmm. So the FDIC was established in the Great Depression. So in 1933, the FDIC was established. And prior to it being established in the late 1920s and early 1930s, thousands of banks were failing because of the Great Depression. Mm-hmm. Many of those banks experienced what we called a run on the bank. Mm-hmm. In other words, there was a rumor in the community that the bank was having financial difficulties. And so everybody who was a depositor went to the bank and wanted their money because they were afraid, because so many banks had failed, they were afraid that their money would be lost. And what happens when there's a run on the bank, no bank in the country keeps enough cash on hand to pay all its depositors. So when a lot of people would show up to withdraw their money, the bank would basically run out of cash, and they would end up closing. And so in order to try to stop people from running to the bank and withdrawing and having a run on the bank and closing, they designed deposit insurance. And what deposit insurance basically does is say, if your bank fails, the government or the FDIC will pay you up to your insured deposit amount.
Okay.
So when this was established in 1934, that was $2,500. Today, it's $250,000.
Big difference.
So that was the genesis for the FDIC. The goal was to stop the people running to the bank and withdrawing money by ensuring them that they would be able to get their money if the bank failed.
Okay.
So the FDIC was set up as what you would call an independent agency.
Okay.
It's not funded by the government. It's actually funded by premiums that the banks pay that are insured.
Okay.
Now, by independent, that doesn't necessarily mean that it's not influenced by the government and the
Sure.
current administration. But it is overseen by a 5-member board of directors.
Mhm.
Originally, it was 3. It was increased to 5 a number of years ago. And each member is appointed by the president and confirmed by the Senate, just like you see for, Supreme Court justices, members of the cabinet, those type of things. And currently, there's 1 vacancy and there's 4 members of the board.
Okay.
The chairman is Jelena McWilliams, who was appointed by President Trump as chairman.
Mhm.
The vice chairman is vacant. By law, the board consists of the director of the Consumer Finance Protection Bureau,
Okay.
which is currently Kathleen Kraninger,
Mhm.
and also the comptroller of the currency is automatically a member of the FDIC board,
Okay.
and that's currently an acting position, Brian Brooks.
Mhm.
And then you have Martin Grunberg, who's a member of the board. He was former chairman of the board.
Okay.
And then 1 member of the board is required to have state bank supervisory experience.
Gotcha.
Right now, we do not have a member of the board that has that.
Okay.
No more than 3 members of the 5-member board can be from the same political party. So in essence, typically when a Republican president's in power, 3 of the board members are Republican and 2 are Democrat, and vice versa.
Gotcha. Okay.
But they are appointed for a 6-year term. So it could be possible that some members of the board, cannot be replaced during a president's term in office.
Sure. Okay. So they can't cut off their term and install someone new?
No.
Okay.
It's sometimes it's customary for the chairman to maybe resign with a new change of administration,
Sure.
but they're not required to.
Okay.
And the chairman is appointed for 5 years.
Okay.
So that's quote the independence. It's run by this 5-member board.
Okay.
And its funding doesn't come from the government, from your tax dollars.
Sure.
The funding comes from deposit insurance assessments. So each insured bank pays annually money to the FDIC for its deposit insurance.
Okay.
So in last year, in 2019, the FDIC got $4.9 billion in deposit insurance assessments. Most of its other income comes from investment income. So as I'll explain later, the FDIC's insurance fund is currently $100 billion.
Oh, wow.
And it's
Okay.
invested in treasury securities.
Gotcha.
And the interest on that in 2019 was $2.1 billion.
Wow. All right.
So there's like $7 billion right there that they collected last year. Their operating budget last year was $1.9 billion. So you can see that the fund grows because the revenues exceed their expenses.
Cool.
And I've put a couple charts on here. One at the bottom here shows these are the expenditures from 2010 through 2019. You can see it's been declining.
Sure.
The reason has been, in 2008 was a banking crisis. The FDIC hired a lot of people. They had a lot of bank failures.
Right.
And over time, as a number of problem banks has declined, so has the number of employees.
Sure.
And then I've also put on here a chart that shows kind of where that budget is. So
Okay.
most of the budget goes into the supervision program, which I was a part of when I worked for the FDIC. This is the division, the groups that examine banks.
Mhm.
And then this is the receivership management. This is the group that manages failed banks.
Okay.
There's a group that runs the insurance program, and then you get your general administrative expenses.
Sure.
So there's almost 6,000 employees at the FDIC spread across the country. And that's down from 8,000 in 2010, just kind of an overview.
Mhm.
So now I want to really talk about what the FDIC does. And it really does four major things. And I'll talk about each one individually, but it insures your deposits. It examines and supervises financial institutions, manages failed banks, and makes large and complex financial institutions resolvable. And that's a more difficult concept that we'll get to it when we get to it. So, Mike, as you said early on, you see this sign. Well, I don't know that many people go in the banks anymore. It seems like most people do it remote.
Sure.
But if you go into a bank, at the teller stations, on the door to the bank, you always see the member FDIC insured to 250,000. If a bank advertises deposits, it has to say member FDIC. So this is a required notice that has to be present in all banks, all branches, and advertising in that to let the consumers know that you're an insured financial institution.
Okay.
If you don't see this, or you don't see member FDIC when someone's advertising rates of return and stuff like that, that's a clue that it's not an insured entity.
Okay.
So what does deposit insurance cover? It covers your deposit if the bank fails. So if you have a deposit account and someone gets a hold of your checkbook and writes a check for $10,000,
Sure.
and that money gets taken out of your account and you lose that $10,000, that's not covered. The FDIC doesn't insure that.
Okay.
You know, there's other mechanisms with bank insurance and other things to protect you from those losses, but the FDIC insurance does not cover that. It's only if the bank fails.
Okay.
Now, since the FDIC was created back in 1934, it's when it started, no depositor has lost one penny of FDIC insured accounts. So the system has worked very well. If you had insured deposits and your bank failed, you got your money.
Cool.
So in order to do that, the FDIC maintains a deposit insurance fund. And as I mentioned before, as at the end of last year, that fund had $110 billion in it. Okay.
Right.
In addition to that, the FDIC is backed by the full faith and credit of the US.
Okay.
So that in case, for some reason, they needed more than $110 billion, they can borrow from the US government.
Okay. And they'll back them up.
Yes.
Okay.
So banks pay these assessments based on a couple of things. The one is the amount of deposits they have. But the rate that they pay against those deposits varies based upon the risk that the institution presents.
Okay.
And that risk determination is rather complex. It involves a number of variables. It used to be that everybody paid the same rate regardless, but they changed that a number of years ago. And so now, if your bank is rated more poorly by the FDIC, and you'll see later on, I talk about how banks are rated, you pay more. So
Sure.
if you're a bank that's in trouble, you pay higher deposit insurance assessments. Or if you make riskier loans or have less capital, you pay more for your deposit insurance because you have a higher risk of potentially failing and costing the fund money.
That makes sense.
Okay. So here I just wanted to show you, there's currently almost $8 trillion of insured deposits.
Okay.
Okay. And there's $110 billion in the deposit insurance fund. That's a huge difference, right?
Right.
So this chart shows you the relationship of how much the FDIC has in its insurance fund versus the amount of insured deposits there are.
Okay.
So if you look here at the end of 2019, the FDIC had about 1.4% of insured deposits in its insurance fund.
Okay.
If you look way back here in early 2011, and if you went back a little bit, it'd be even worse, the fund was actually negative.
Sure.
In other words, because of the banking crisis in 2008, the FDIC had to pay out everything that was in their deposit insurance fund
Sure.
and had to borrow from the US government in order to pay depositors or ensure depositors were safe.
Okay.
So under the law, the FDIC is required to maintain a minimum ratio of 1.35%.
Okay.
So they're currently above that.
Mhm.
They're allowed to go above it based upon what they see as the overall risk in banking.
Okay.
So if they think there's still more risk in the 1.4% they have, they can continue to charge banks and build that fund.
Sure.
They also have the option, once they reach this ratio, of rebating back to the banks or charging them less.
Okay.
So that, if a bank maybe paid 100 basis points this year, maybe now next year they'll only charge them 50 basis points because they don't need the
much
money
money.
in the fund because the fund's at a level that it's required to be at.
Okay.
So that's the basics of deposit insurance. We keep the fund available for that.
Okay.
Now, the other main thing, and this is where they spend most of their budget, as you saw earlier,
Hmm.
is the FDIC is involved in examining and supervising financial institutions. So what does that mean? In order to make sure banks don't fail or to try to keep them from failing,
Hmm.
banks are highly regulated.
Sure.
So in order to ensure that they follow those regulations and ensure that they're making good loans, making good investments, the FDIC, along with other regulators, there's the Office of the Comptroller of the Currency, there's a Federal Reserve, there's state banking departments,
Hmm.
all examine banks on a regular basis.
Gotcha.
So the law changed recently, but before I retired, for instance, if you were a well-run bank,
Hmm.
and you were under 250 million in size, you maybe got examined once every 18 months. Or
Sure.
if you were a larger bank, you got examined once a year.
Hmm.
If you were a problem bank, you may have got examined every 6 months.
Sure.
So depending upon the risk that you present, there's exam intervals there to ensure that the FDIC and the chartering agency make sure they know what kind of risk that bank presents and can intervene if they're getting into trouble to try to correct the problems before the bank gets into trouble or fails.
Hmm.
As part of the examination process, banks are rated from 1 to 5,
Okay.
1 being the best, 5 being the worst.
Hmm.
And that overall rating is based on an analysis of these 6 areas. It's called the CAMELS rating,
Okay.
where C stands for capital,
Uh-huh.
A stands for assets,
Uh-huh.
M for management,
Okay.
E for earnings, L for liquidity, and S for sensitivity. So these are 6 areas that get a sub rating from 1 to 5.
Gotcha.
And then an overall rating is assigned from 1 to 5.
Gotcha.
So, and then the exams also make sure that banks are following all the applicable rules and regulations to which they're subject.
Hmm.
And exams can take anywhere from, a couple weeks to a couple months, depending upon their size, their complexity, and all those things.
Hmm.
At the end of the exam, a rating is assigned. So typically, if you're pretty well run, you may get rated a 1 or a 2.
Okay.
And so you may have a weakness or a deficiency, small, not really critical. The FDIC and the other regulators will generally use persuasion to try to get you to make corrections. So let's say they think your capital level is too low. So when they send back their report of examination, they may tell the bank, hey, we think that you ought to have a higher level of capital, or you need to have an audit in this area, or whatever. They'll use persuasion to try to get banks to make, because usually well-run banks will take the exam report and they'll try to make corrections.
Right.
If a bank is rated 3, typically instead of persuasion, the regulatory agencies will use what they call an informal enforcement action. So that either termed a memorandum of understanding or a board resolution or similar term.
Mm-hmm.
It's an informal agreement between the bank and the regulatory agencies, and it's confidential. It's not disclosed to the public.
Sure.
And it lays out one or more items that the bank is specifically required to do. So it may say, you'll maintain capital at this %, you'll reduce your problem assets by X amount, you'll improve your earnings, you'll, those type of things. And then typically it requires the bank once a quarter to report to the agency about how it's doing with regard to those issues.
Sure.
If the bank deteriorates and is rated 4 or 5, typically that becomes what we call a formal enforcement action, like a consent order or a cease and desist order. These are actually public.
Right.
These get published by the FDIC at the end of each month on orders that were issued the prior month. So formal enforcement actions obviously carry more weight because they're formal. The FDIC can take you into court, et cetera. But they're designed to more forcefully require banks to take corrective steps.
Sure.
Besides examinations, the banks are also required to file call reports. And what these are detailed balance sheets and income statements and other information that tells the public what condition they're in.
Sure.
These call reports are public information.
Okay.
You can go on to the FDIC website. You can go to the right section and put in your bank's name, and you'll get all the financial information that the bank has published in their call report for you to look at.
Cool. Okay.
So lots of rating services and others go in and get that information, and they put out information about banks, and they rate them themselves. They let you know whether or not they think this bank's in trouble or not. All this is done to try to put some public pressure on banks to make sure they're operating safely and soundly, because negative publicity obviously is not good.
Right.
The FDIC and others also use all this information and do offsite monitoring. So for instance, every quarter when call reports were filed, I used to get a list of banks that were growing very fast. Typically, historically, banks that grow too fast end up getting in trouble because they don't have the controls in place to control the growth.
Sure.
And so if they're growing really fast, we might send an examiner in, or we might call the bank and say, hey, what's going on? We notice you're growing very fast. Are you maintaining your credit quality standards? Those type of things.
Sure. Right.
So we use them a lot to identify banks that we might need to look at sooner than their exam schedule.
Gotcha. Okay.
So again, all this is designed to try to maintain an awareness of the bank's condition, and to the extent we find deficiencies, to get the banks to correct those before they would fail.
Okay.
The same thing's done by the FDIC with regard to consumer protection laws and regulations. So truth in lending, equal credit opportunity, fair credit, truth in savings, all those Community Reinvestment Act, all of those regulations designed to protect consumers. The FDIC has a division that examines banks for those as well.
Gotcha. Okay.
And it's the same thing. They have intervals based upon the rating of the institution. They also sign overall ratings that guide how often they're reviewed and what type of action they might take if they find a deficiency.
Right.
The CRA, Community Reinvestment Act exams are public. Those you can go and you can get and you can read how well the bank is doing reinvesting in its community.
Okay.
The consumer protection exam is obviously confidential.
Sure.
Just like the safety and soundness exam is confidential. As part of the Consumer Protection Division, they also have an area that handles consumer complaints. So if someone thinks their bank treated them wrong or did something wrong, you can write to the FDIC.
Okay.
And the FDIC will actually contact the bank, try to get the bank side of the story and see whether or not there's an issue that they can help resolve or not.
Gotcha. Okay.
And again, all the banking regulators do this. The third thing that the FDIC does is manage failed banks. So, and one thing I want to stress here is that FDIC doesn't actually close a bank. It technically has the ability to do so, but typically or normally, the chartering agency closes the bank. So banks are either chartered as a national bank by the comptroller of the currency, or they're chartered as a state bank by each individual state.
Sure. Okay.
So if it's a state chartered bank and the state believes they should be closed, then they work with the FDIC prior to the closing.
Okay.
And the FDIC will actually send its receivership folks into the bank a month or more before the bank actually closes, gather up information about that bank, and they put that out on typically a secured website. And then as it's getting close to the point where it's going to fail, they actually then solicit other banks that might be interested in acquiring that bank.
Sure.
And that bank can go into this website and look at its loan portfolio, its deposits, its investments, to see whether or not they actually want to bid for that bank when it fails.
Take on those depositors and all of those, those assets. Okay.
Yeah. So when a bank fails, the FDIC is normally appointed by either the comptroller of the currency of the state as the receiver.
Okay.
So as the receiver, then they manage that failure to collect the assets of it, to make sure the depositors are paid. And they're required to, there's a least cost requirement. They're required to resolve the bank in the least costly way.
Okay.
Because there's basically three ways that the FDIC makes sure its depositors are paid. Okay. They can pay out insured deposits. So they can just say, hey, you're a depositor, here's your $125,000. And they can make a direct payment.
Okay.
That happens, but not very often. The FDIC can actually run the bank for a while. They've done that. They've done that a few times, but that's not what the FDIC wants to do.
Okay.
Most of the time, they transfer the deposits to another bank.
Okay.
In other words, they get another bank to acquire it. And I'll show you an example of a bank that failed just last week here coming up.
Okay.
But if transferring the deposits to another bank is more expensive than just paying the insured deposits, then they're required to pay the insured deposits.
Gotcha. Okay.
It's least costly.
Gotcha.
In the same way, then, once they are receiver, they're responsible for trying to collect the assets of the failed bank.
Okay.
And most of the time, they try to sell those assets to the acquiring bank.
Okay.
But sometimes there's assets they can't sell. So the FDIC actually has a division that tries to collect those assets.
So are you talking about like loans? Yes. Okay.
Yes.
So
like
a
they've got a loan. They've got a loan to somebody that's not paying. The bank that buys it says, I don't want that. I don't want to have to collect that. And so the FDIC will collect it.
Sure. Okay.
So they'll work with the borrower to try to get repaid.
Gotcha. Okay.
Right. So here last week, and the banks typically close on Friday. Last Friday, I got this press release. I I sign up at the FDIC to get their press releases, but a bank in Kansas failed.
Sure.
The state banking department, the office of the state bank commissioner, closed the bank
Okay.
and appointed the FDIC as the receiver.
Okay.
Okay. And then it goes on to say, the bank experienced longstanding capital and asset quality issues.
Mm-hmm.
To protect the depositors, the FDIC entered into a purchase and assumption agreement with Equity Bank to assume all of the deposits.
Okay.
All right. So right there, if you were a depositor and you had $400,000 in the bank,
Sure.
and only 250,000 of that was insured, this transaction got you all $400,000.
Right. So you get all your money back.
They assumed all the deposits.
Gotcha.
Okay. And then it says the bank had approximately 70 million in assets. And I believe it says here somewhere that the Equity Bank agreed to purchase essentially all of the failed bank's assets.
Awesome. Okay.
And the FDIC believes it will lose $18.3 million.
Okay.
So in looking at this, they had they did not get $70 million for the assets because there's only $68.7 million in deposits. If they lost $18 million, they probably only got about $50 million value for the assets.
Gotcha.
So in this case, the FDIC loses $18 million it has to pay out on a $70 million bank.
Okay.
Okay. The last thing the FDIC does, and this is a lot more complex, we're just talking at a very high level. Banks like Citibank, JP Morgan, Wells Fargo, Bank of America, PNC, those bigger banks, they have thousands of subsidiaries.
Sure.
And their structures are very complex and intertwined. And so if one of those banks were to fail, it's extremely difficult legally and otherwise to try to go through and figure out how to resolve it.
Sure.
How to
how
to liquidate it. You know what I mean?
Right.
The Dodd-Frank Wall Street Reform and Consumer Protection Act did something kind of unique in that regard. Is it requires these banks, the largest banks, I think it's the largest 8, it might be the largest 10, to actually develop plans on how they could be resolved.
Oh, so they do the work for you.
Yes, and part of that requires them to simplify their structures and make their structures and that so it's more easy to do.
Okay.
And this is an ongoing process that gets looked at constantly, but the whole goal is to say if one of those fails, we have a way to resolve it in a relatively easy way.
Okay.
All right. So that is my general overview of what the FDIC does.
Sure.
There's a ton of information at the FDIC's website.
Yeah.
And I would encourage people who want more detailed information to go, but there's sections for consumers, there's sections for bankers, there's sections for analysts. It gives you lots of history and other information.
Okay.
You can also find, the bank's financial information on the website.
Right.
This is the number if you have a question. It's their consumer complaint line.
Okay.
So if you have a concern about your bank, you can call. They'll help you if you file a complaint if you need to, etc. And then these are the websites of other banking regulators, the Federal Reserve, the Comptroller of the Currency. And this is the Federal Financial Institution Examination Council's website, which is made up of these 3 regulators, the state conference, state bank supervisors, and the credit union administrator.
Gotcha. Okay.
So with that, Mike, I'll give you back the screen, and then I'll be happy to answer any questions you might still have.
Yeah. One thing that came to mind was, so let's say I had a safety like a savings account that had, you know, or if I had like more than $250,000, is there a way to get around that $250,000 limit, or am I stuck only being insured for the $250,000?
You can get more than $250,000 of insurance protection. I would recommend people who have more than 250,000 go to the FDIC's website and look at the brochure titled Your Insured Deposit.
Sure.
Simply, for instance, you're insured up to 250,000 for accounts held in your individual name.
Okay.
So if you have a checking account, a savings account, those are combined to look for your $250,000.
Okay.
But you also can have up to $250,000 insured in a joint account. So you and your wife,
Sure.
if you have a joint account, you get another $250,000 of deposit insurance.
Gotcha.
There's other type of accounts you can have that are also separately insured.
Gotcha.
So
Okay.
you could easily have more than 250,000 if you've structured it correctly. It could
Okay.
all be insured.
Cool. Now, if I, like, let's say instead I tried to have like 2 different accounts at 2 separate institutions, would both of those accounts be insured since they're at separate institutions?
Yes.
Gotcha. Okay. Cool. I've been noticing a lot of credit union commercials on the radio and whatnot, and they don't usually say FDIC insured. I am assuming there's some other institution that does that.
Yes. They are I can't remember the exact name of it, but credit unions are also insured by their own fund.
They have their own
Similarly,
regulatory agency.
yes,
Okay.
they have their own
Gotcha.
insurance.
Cool. So since you work at the FDIC, you obviously have a lot of, like, I guess you could say, insider information about banks and their finances and whatnot. And some of that's made available to the public, but obviously some of it isn't. Are there protections in place so that employees don't use that information incorrectly?
Yes. First of all, any information that we become privy to about a bank through the examination process or otherwise is confidential, can't be disclosed.
Gotcha.
I can't talk about it. I can't tell you the bank's rating. I can't tell you anything about the intricacies that I've learned that isn't public.
Sure.
Also, as an employee of the FDIC, you're prohibited from owning any stocks of any banks. Okay.
Gotcha.
So I could not own bank stock for my 37 years at the FDIC and for a couple of years afterwards. Now that I've been away from the FDIC for 6 years, I can invest in bank stocks. But they do have a very strong ethics program at the FDIC.
Sure.
So annually, you're required to disclose what you own, who you owe money to, et cetera. For instance, when I first joined the FDIC, you could not get a loan, even a mortgage loan, at a bank that you would examine.
Oh, wow.
Now,
Okay.
subsequently, now you can get a credit card as long as it's on the same terms and conditions. You can get a mortgage as long as it's on the same terms and conditions.
Mhm.
But you can't get a personal loan. I couldn't go and say I want to borrow $10,000 to buy a car. I couldn't do that at an FDIC bank that we examined.
Gotcha.
So there's lots of restrictions on that to make sure that you're impartial in the exam process.
Right. Okay, that makes sense. The last thing I had a question about is, what are the kind of people and what kind of qualifications do you need to work for the FDIC?
Well, the FDIC has a wide range of positions.
Sure.
So, I mean, they have examiners, they have attorneys, they have economists, they have secretaries, they have office staff, they have, just a whole broad range.
Sure.
On the examination side, to get hired as an examiner, typically they're looking for a college degree
Hmm.
and with some accounting hours, some accounting knowledge and experience. Although that's, I think that's been reduced now, because typically the FDIC hires now nationally,
Sure.
and the program they currently have is they're trying to hire folks more what I would call universally. When I first was hired, I was hired specifically to be an examiner for safety and soundness.
Right.
Others were hired specifically to be an examiner for compliance. Others were hired to be specifically people that worked in the failed bank side.
Mm-hmm.
They have a program now where people are hired to be hired by the FDIC.
Sure. Okay.
And for their first year, they work in all three areas of the FDIC to learn
All the
more
different parts.
broadly about the FDIC. And then when their first year is up, if the FDIC needs a compliance examiner, that person becomes a compliance examiner.
Gotcha.
If they need a safety and soundness examiner, they become a safety and soundness examiner. But typically they're looking for a college degree or comparable experience. So if you worked in a bank for a number of years, that might qualify you as comparable experience.
Okay.
Almost all of the hiring the FDIC does now is under USA Jobs.
Sure. Right.
So if you go there, you would be able to see current positions being advertised.
Gotcha.
And they would, in that advertisement, it would tell you the prerequisites to be able to apply.
Cool. Well, awesome. All right. Well, thank you so much for coming on and explaining so much about the FDIC, and for kind of enlightening us about how banks are regulated. That's awesome.
I'm happy to do it. Thank you very much for asking me.
Yeah, absolutely. So thank you everybody who watched. I hope you learned something. I hope you got what you needed out of it. And we'll see you next time we learn about something financial.